Markets, our markets as well, potentially setting themselves up for another weak day of trade. Yesterday, remember, it was the Bank Nifty that staged a fall and showed signs of weakness. A bunch of earnings globally and locally, and that's how tough it's looking. We're setting ourselves up for a decline, at least implied Nifty is indicating to a 200-point cut in early hours of trade. Well, a quick check of what's happening globally. It's a tough morning. Wall Street was weak, but let's quickly look at what's happening in Asia. Asian markets are also seeing heavy selling in early hours of trade. Japan is down for the 6th straight day, and this morning it's got a cut of 3%. Remember, Japan has been the best performing market across Asia, and it's been falling for the last 5 days, continues to fall this morning, but the cuts there are very sharp. The rest of the Asian markets declining, but not looking as bad as the Japanese index. Well, let's take you through what is leading to the sell-off across Asia, and it's all to do with how rough it's been for Wall Street in overnight trade. The Dow, the Nasdaq and the S&P declined sharply in overnight trade. The Nasdaq and the S&P have had the worst day in the last 2 years, so pretty significant in that sense. The Dow Jones was down 1.5%. The Nasdaq took it to its chin, down 3.6%, and at some point that market was trading with a 4% cut. The futures, though, indicating to a marginally positive close after market closing. Well, just to take you through what's happening, the S&P 500 largely declined, and so did the Nasdaq. The sell-off came in on back of weak earnings being posted by Alphabet and Tesla. Now, in terms of Alphabet, while the revenue and the profitability beat street expectations, revenues from the YouTube vertical took a huge cut. That disappointed the street and led to the stock selling off quite sharply. Alphabet was down 5%, and along with Alphabet, it took all the other stocks like Apple and Microsoft lower in trade as well. Tesla had it quite rough. The stock was down 12.5% as revenues declined for the very first time. In fact, they dropped by 7% year on year since 2020. So in the last 4 years, Tesla has seen an increase or an uptick in revenue, marking this to be the first quarter where sales have actually declined for the company. Well, it was a perfect storm where the markets were overbought, valuations are stretched, earnings are slightly disappointing, at least in terms of what was posted on Wednesday, and economic data that came our way for the US markets was also below what the street was expecting. But let's remember, despite the weak earnings that we saw on Wednesday, 25% of S&P 500 earnings have actually beaten street expectations. In terms of economic data, you had weaker than expected manufacturing data that dented sentiment. The PMI flash manufacturing output fell 49.5, so saw a contraction. Housing sales also declined. The rest of the week, we'll see GDP data, so there is a little bit of nervousness for Wall Street traders. Like I said, that's what Wall Street looked like, Asia taking a cue and selling off. And of course, it seems like D Street will take that handover and also start off the day fairly weak. But we have with us a quick check coming in on global markets. If we can quickly find out if we have a guest ready to take us through it. So Norman Chan, independent investment strategist, joins in on the phone line. Hi, Norman. Thank you very much for joining us this morning. Norman,
Sure.
What is happening? Weak earnings from Alphabet. Tesla has disappointed. Economic data that's come in has been weak. The Dow, the Nasdaq, and the S&P 500 have all sold off. Now, do you feel like this is a one-off, or do you feel like this is the start of that much anticipated selling that world markets are expecting?
Well, I think this is pretty much still a correction, and the corrections may last maybe a couple more days, and or maybe rebounding more, sooner tonight. But so far, I don't think this is a reversal of the uptrend. I think the strong uptrend, especially on tech stocks, remain intact. But this is just a very healthy and needed technical corrections that the mega tech stocks, especially the AI stocks, is probably going through because of the earnings disappointment from Tesla and a little bit from Google. Actually, Google earnings is not that bad. It's only just YouTube is slightly lower than forecast, but the search and also the AI cloud has been doing better than market expectations. And so I don't think this is going to be lasting very long, unless all other mega cap tech stocks like Microsoft, Amazon, or Meta all come out with similarly weak earnings. Otherwise, if they report in a couple of days or couple of weeks with much better earnings results, then the market can resume uptrend. But so far, I'm saying the market is going through a sizable corrections right now.
It's a little concerning when you say sizable correction. So I'm assuming that this is not going to be a shallow one. Secondly, with most of those tech stocks falling 5 to 10% in overnight trade, would you already go in and bargain hunt, or you would wait for this tide to fall? Also, do you anticipate it to be one big sell-off and then we move on, or this is going to be a grinding, slow correction for Wall Street and then the rest of the world as well?
Of course, the rest of the world is clearly affected. In Asia, we've seen some major sell-off in Japan, in Taiwan, as well as in other markets. And when the U.S. market staged a kind of a 3% drop in a day, especially since it hasn't done that before like 18 months or longer, and an Asian market almost have a knee-jerk reactions of falling through. But I would say that the corrections may not last very long because the fundamental of mega cap stocks is still very strong. I think it's a market hunting opportunity because you can see from earnings results from TSMC earlier, or maybe ASML, that AI and chip, and semiconductors, especially hardware, is still doing quite strong. And if there are more earnings in the next couple of weeks, showing that the AI and the big cap tech stocks names are doing better than the rest of the market, and I think the tech body can extend again. And but so far we've seen some Nasdaq, for example, before last night was up 20% year-to-date in 7 months. So I think last night is pretty much a major needed technical corrections for the market.
Valuations, can we assume then that you're comfortable, you're okay with the valuations at which some of your front-running Nasdaq companies are currently trading at?
Well, yes, depending on which particular companies. For example, one of my favorite stock, NVIDIA, they're trading at around, nowadays 30 times 2025 earnings. It's not a very cheap level, but for a near monopoly on the hottest, AI GPU theme, I think that's multiples. There's a reasonable multiples, and we do think there's further upside for stocks like NVIDIA, Meta, or maybe Google, and especially like Microsoft. Although their earnings their valuations are elevated, they are very, they are not really in the bubble area. And but of course, some of the stocks like CrowdStrike we have reviewed recently to see if there's a good bargaining opportunities. We still think the valuation is a little bit high at around 55 times PE. And so selectively, I would say that most of the so-called Max 7 stocks, maybe except Tesla, I would say that the valuation is not cheap, but it's still okay. And I think most of the tech stocks were up like 20, 30, or even 40% so far today. So last night when they sell off 5 to 8%, it's a sizable sell-off, but still pretty much a correction on uptrend.
Norman, very quickly, the much anticipated rate cut, is that in the price already and been discounted?
I would say mostly of the September cut, yes. The question is whether we will have 2 or maybe even 3 rate cuts this year. And more importantly, is it a starting of a long and slow rate cut cycle? If that's the case, then the market may not have reflected yet. I do expect the rate cuts to extend in 2025 for another 1%. And that 1% cut next year may not be reflected yet. But of course, September cut is very much reflected in the market.
Right. Thank you very much, Norman. Great talking to you this morning. It looks like this is the start of that much anticipated correction. Remember, it's a perfect storm. Markets are overbought, earnings have disappointed or not met street expectations in that sense, and economic data coming in as well is weaker than expected, and more importantly, that much anticipated rate cut seems to be discounted by the markets for now. Well, but it looks like our sell-off pretty much started even before the rest of the world did, Agam. We had the budget. It pretty much left us with not wanting more, but it didn't give us a cue to move higher or lower in that sense. Yesterday, what we saw on Bank Nifty was unsettling. This morning, of course, global cues are contributing or indicating it could be a rough start. And we also have expiry on the 31st. So it's not looking good as we set ourselves up this morning.
You're right, Samina. A lot of these factors have actually turned for the worse, at least in the last 3 to 4 days. And I'm going to talk about that in a little more detail when it comes to positioning, FPI positioning specifically. So firstly, let's start with the Nifty. At the moment, we're looking at the Nifty inching towards the lower end of the range, which is 24,000. Of course, while there is a lot of writing around 25,000 calls, at the moment, in the immediate term, we're likely to see a little bit more resistance around 24,700, 24,800. But on a day where we are going to see more weakness, there's a likelihood that this range could perhaps fall through, and your immediate resistance level could come off. In fact, that could become 24,500 as well, because that's been a little bit of a pivot level of late. I want to very quickly talk about your FII positioning. Now, over the last 3 days, just take a look at how your longs have unwound so substantially as far as futures are concerned. 3 days ago, on the 22nd of July, your long standing was around 77%, and that has already come off substantially to around 69%. Do remember that this is still a very, very high number. So there is scope for further unwinding to come through as far as your futures are concerned. As far as the Bank Nifty is concerned, a crucial support was already breached yesterday. It was around 51,500 and thereabout. We closed below that mark, and now the level that we're keeping an eye on is yesterday's close, that is 50,900 and there around. Should we see the Bank Nifty weaken further, and should we see the Bank Nifty in fact test 50,900, well, it's not going to bode very well, because that'll further force a lot of your put writers to move out of their trades, and that could perhaps further exacerbate a downward move. So all in all, at the moment, sentimentally, things are not looking that good, and we are also looking at a good amount of writing as far as your calls are concerned. So these are some of the factors that we should keep an eye on and bear in mind as we move into trade today.
Right. It's tough, and FIs have actually taken the opportunity and dumped stocks on D Street. So you had the FI selling number that came in to about 5,100 crores in trade yesterday. What you also want to remember is that FIs have cut their longs, DIs have cut their shorts. It was seeming like after 4 days of consolidation, Agam, if there was a little bit of a grinding range-bound trade today, we would have potentially held up. But because of what we're getting in terms of a handover from world markets, it's not going to be as easy. And more importantly, earnings in the last few days have also come in largely disappointing, I'd imagine. And all that put together is not helping the street at all.
The takeaway I have is that from the broader markets, the earnings have been really good. And we're going to talk about them. As far as the benchmarks are concerned, the bellwethers are concerned, well, they're so-so. But perhaps that was also largely expected.
That explains why the buying has been in the broader markets, not, of course, in the last couple of weeks, but what we've seen in the run-up in the last 1 year. So broader markets, mid-cap names have done well, pockets have done well. So IT, largely, some of those companies have outperformed and beaten street expectations. Sure, expectations going into those earnings have actually been fairly low. But talking about stocks to watch, you've got more than 30 companies that will be reporting earnings later on in the day. But between yesterday's close and this morning, you've had a barrage of earnings that have been announced, and we'll quickly take you through all the stocks that you need to watch out for. First up on the list is Axis Bank. Disappointing, to say the least. Markets are not going to be pleased with Axis Bank's reporting. To highlight what went wrong for them, their margins have held up, but provisioning has gone up substantially. Of course, the management had said it's seasonally a quarter when you see provisioning actually rise in verticals such as agriculture. Asset quality has deteriorated, and profitability has also been impacted due to a deterioration in asset quality. ROAs have also shrunk sharply, 19 bips Q on Q and about 15 bips YOY as well. The net interest income has come in at 13,448 crores versus 11,959, so that's up 12% YOY. 3% Q on Q. Provisioning is also up, like I said, at 2,039 crores versus 1,190. That's up 71% Q on Q. PAT is coming at 6,000, up 4%, but down 15% quarter on quarter. Gross NPAs, net NPAs have also risen, and close slippages have stand at 4,793 crores versus 3,471 crores, up 38%. So all in all, asset quality is a huge problem for Axis Bank. Slippages have gone up, on back of which profits have deteriorated. My expectation is that Bank Nifty's has been anyway weak, and now with this weak sort of earnings coming from Axis Bank, a big gap down on the stock is what's anticipated. In terms of L&T, they actually managed to do quite well. So their numbers beat street expectations on revenue. Profitability, some may argue, may have been slightly lower than what the street expectation was, but this turns out to be one of the best reporting quarters for L&T. Revenues up 15%. EBITDA is up 15%, and net profit has also come in about 10% higher. Just to take you through what's worked for L&T this quarter, and this is what the management has said, they've registered a strong growth on order inflow as well, largely coming in from the export book that they own. 46% of the order book comes from outside this country, and that is expected to continue to see an uptick. International orders were at 32,598, international constituting 46% of the total order inflow. Well, you also want to keep in mind that the management has indicated that despite the strong momentum that is expected domestically, now that elections are also behind us, the heat wave is also behind us, L&T expects a slowdown in the pace of infrastructure progress due to a shortage of labours. They've said, and the management has said, that a large part of the skilled labour that they look to hire is, of course, opting for jobs in the Middle East, and that is, and potentially could be a problem. But all in all, good earnings. Their global order book is looking strong. Order inflow has been good. Profitability, revenue, both have seen an uptick in the quarter. Well, SBI Life, don't know how we're viewing this, but it doesn't seem like it's been too great a quarter. ULIPs is a big contributor in terms of business, which is a low-margin business, so that could explain why the street may not be too impressed by what they've seen on SBI Life. Premium income is up 15.5%, net profit is up 36.5%. Value of new business is down. Margins, in fact, on the value of new business is down 200 basis points. AUM is up 26%. Brokerages, in fact, some that I went through have said that they're a little circumspect and very significantly watch out whether the management can keep up to that guidance on margins. Because a big chunk of their business comes from ULIP, the product mix could be a little bit of a concern for SBI Life going ahead. So again, good numbers, but not taking too much from what we're left in terms of a revenue there. A couple of broader market names had reported. Bikaji, very strong numbers. Revenues was up 18.7% at 572 crores. EBITDA was up 39%. Margins have improved over 300 basis points, so coming in at 16 versus 13.6. Net profit is also up a whopping 40% at 58 crores, and volumes have also increased significantly. They've also improved and increased their direct coverage into their markets, so it's actually worked out really well for Bikaji Foods in this quarter. Trident numbers weren't very good. Revenues were up 16.7%, but profits were down 19%. EBITDA was down 2.6%, and margins have also shrunk to 12.9 versus 15.5. So Trident weak, Bikaji good, Axis weak, L&T good.
Right. Well, I want to talk about Oracle Financial Services. This one has been on a tear on the last 12-month basis, last 6 months basis, and for good reason. I'm going to give you the numbers sequentially, even though they look year on year, because we're actually looking at a whopping 6% growth on a sequential basis for OFSS. It's actually seen your EBITDA margins expand substantially once again on a quarterly basis, coming in at around 47.6%, and net profit again sequentially rising around 10%. Now, there are a lot of factors working in favor of Oracle Financial Services. Among many others, we've seen product segment revenues rise 7%, and services as well. That's declined by around 3%, but it is essentially the products segment which is driving the growth here, notwithstanding, of course, the several important deals that they continue to work with. The other one on our radar, of course, is GSPL. We can't not talk about this. It looks like a slightly higher than expected quarter, where we have revenues rising 8% year on year, and while margins remain flat, they're still at a healthy 20.9%, and net profit, on the other hand, did decline by as much as 21% on a year-on-year basis, but that's also on account of certain one-offs coming through. And finally, PG Electroplast. Now, this one is the other big mover in the last 12 months, and we've been talking about so much happening in the manufacturing space, and PG Electroplast has clearly, managed to benefit from the tailwinds that the entire sector has seen. So we've seen a whopping 95% growth on a year-on-year basis. We have seen your margins expand as well to around 9.9% year-on-year by around 20 basis points, and net profit rising 147% year-on-year. And all the headline numbers are well ahead of expectations. And that's not just the case for PG Electroplast, but a lot of the peers in this specific industry are also, well, gaining. So, well, I guess I have all hits in my list so far, Samina.
Good pick. We've got a few more from the broader markets. Again, a mixed bag. Sona BLW, will start with that. Revenues were up 21% at 891 crores. EBITDA has come in at 23.2% higher at 249 crores. Margins have improved marginally, actually largely flat at 28% versus 27.7%. And net profits have also improved by 26.8% at 142 crores versus 112. Craftsman Auto profits have fallen, and this one might have it rough this morning. Revenues were up 10.9%. EBITDA was down 7.9% at 197. Margins have declined over 300 basis points to come in at 17.1% versus 20.6%. And net profits were down 26.4 crores versus 60 crores, at 60 crores versus 81 crores. So Craftsman is weak, but Sona BLW should get a good start this morning. JK Paper and paper companies have been having it rough for now many years. So this is one more quarter when JK Paper fortunately has done okay in terms of top line. The top line has risen by about 8.2% at 1,713 crores. What has done badly is its profitability and margins. Profitabilities have been hit sharply, down 54.7% at 139 crores versus 308. I'm going to quickly mention IEX because this could be one of those few gainers in today's day of trade. Profits are up 27.2%, revenues also up 18.8%. You've got some more on the earnings, Agam?
Yes, just three more, and this time it's a little bit more mixed. We have Hitachi Energy India, and this is the other one which has had a fantastic last 12 months in terms of price action. And again, this explains because we have good numbers coming in, 28% growth in revenue. Your EBITDA margins coming in at around 3.6%, an expansion of around 40 basis points, and coming in at with the profit coming in at around 10.4% against 2.4 crores. 10.4 crores against 2.4 crores. IGL, on the other hand, it's a mixed quarter. Revenue down around 2%. Margins have expanded by as much as 200 basis points to around 16.5%. And net profit, consequently, has grown around 11% sequentially. And Karnataka Bank, your net interest income has grown 11% year-on-year. And we have seen your gross net profit ratio, NPA, your gross NPA ratio, largely flattish sequentially, and it is mostly the same for NNPAs as well. Your net profit has risen by as much as 8% as well year on year. So all in all, mostly positives here as well.
Well, a couple of good news points as well to mention. Rail Vikas Nigam is back with an order win. They've won an order which is pretty significant, 191 crores. So this one could see a positive uptick in today's trade. Also on RBL Bank, reports indicate that private equity firm EQT is looking to sell 7.9% stake in RBL Bank through a 1,080 crore block deal. This will include about 4 crore shares and at a price of about 226. So keep a watch out for RBL. There could be some sort of a big move when that block deal hits the market after 9 a.m. So that's what we have, but it's a bunch of earnings. But I think the regulator going after the trading segment and the option segment is our big story in Editor's Cut today.
Yeah, absolutely. And we were actually looking at the numbers as far as the intraday trading is concerned. Let's thrown some very interesting trends. I don't know if these trends are encouraging. That's something I will leave to Alex and Sajid to decipher. And speaking of which, Alex, take it away.
Absolutely. Thanks so much, Agam, for handing that to us with the interesting toss that you did, because it is an engaging conversation and Sajid has some answers for us on that front. What we're talking about, of course, is a SEBI report that talks about the trading activity of individuals from FY23. That's the financial year ending March 2023. Remember, this has to be seen as trading in the intraday cash market, not in derivatives. That report that the SEBI put out was the one earlier where it said 9 out of 10 people trading in derivatives lost money, individuals. Here, I think it's interesting because it depends on how you say it. Sajid, 7 out of 10 people trading intraday in the cash market lose money, but equally you can say 30% of individuals trading intraday in the cash market make money.
The number could be much more. But,
Exactly.
But let's put the things in perspective. From FY 18, 19 to 24, we added nearly 6.5 crore new investors into the market. But the thing is that from 3 crores to 9.5 crores, that's what the number is. The survey takes into account top 10 brokers and the samples from them, and the total number of intraday traders there have increased from 15 odd lakhs to 69.8 lakhs. That's nearly 1% of the 1.5% of the total base which got added. So the survey is very focused on the intraday trading part of it, but it does not talk about how the new investors have done in the market or what they were doing, especially with respect to how they were investing in the cash market for delivery or investing, which is a way of doing it, and whether they were a high participant in the IPO market and they used the profits from there to go into intraday market.
So, for example, it may not give you the perspective of somebody who's buying today and selling next week. Just as an example.
Exactly. It doesn't give you that. It only gives you intraday trading, and it also doesn't give you a perspective of whether these investors made money in investing and they are plowing into intraday,
right?
Or is it just an intraday trade which is
are
happening?
Only occupied in
intraday. So the study is very skewed in that sense. But that's a caveat which I want to make before I say that. Okay, if you look at intraday traders, 71% made losses.
Is that bad?
It's not as bad as you think, because it takes you through the entire process of the market learning curve. It says that the more you stay in the market, the loss proportion comes down, which basically means that there's a learning curve for everyone come into the market.
The more you stay in the market, in that, the more time you spend trading in the market. Not holding period.
No. The more, I'm talking about intraday here.
Yeah.
So if a person came in FY 18 or 19 and is there till FY 23, the proportion of losses have come down from 71 to 58%.
Sure.
Which basically means it's a learning curve which is there for every investor, which is there, and that's what markets teach you over a period of time. It also tells you that over 48% of them are younger crowd, which is under 30, which means a lot of college first-time jobs are entering into the market, and they're using their household savings in intraday or in investing in that sense. There are certain good things like the proportion of female making lower
I was
losses.
going to ask you about that.
Yeah, I mean, it says that the proportion of female investors have made lower losses compared to male investors.
But it's been
and it also says that married people made more lower losses than...
Married people made lower losses is what... So, okay.
Compared to singles.
Okay, so the influence of the female gender, it has been said, without using any stereotypes, but it has been said that the risk-taking, the nature is not to take as much risk as the male generally does. And of course, we're not making generalizations, we're not using stereotypes. That has been proven in studies.
But it also gives you an indication. So what's the takeaway? It's basically, fuels to the entire concept of how household savings are moving away from traditional banking deposits to markets.
Yes.
And that's been reflecting in the RBI's household savings data as well, right? The net financial asset flow to equity and mutual funds have gone up from 35% to 47%.
There are people engaged in only trading. That's what this throws up as well.
Yeah, so roughly around 27% have taken up trading as their occupation.
How do you get that?
It doesn't say that very clearly, but it says that large investors which are trading 100 to 500 transactions are they've been categorized as large, and then there is more than 500 transactions. So in an intraday trade, you cannot go put a trade and then go off, right?
Yeah.
So you have to constantly monitor. So the assumption is that if they are going to do 100 to 500 trades in the market, or more than that, then they have to in a year.
Okay.
Then they're doing at least one every 3 days, or they're doing at least 2 trades a day minimum. That's what we are saying. And for intraday trader, you have to buy and sell square off. So you have to be in front of the screen and doing that. And
but couldn't you do that from an application on your phone?
still that's going to be a full-time job, right? You're going to monitor your prices. It's not as easy as going to be. So if you're going to put your price and then the price comes and goes away, you're not able to sell, right?
Fair point.
You have to wait. So they have made it as a full-time occupation, which basically means that roughly around 1 crore of new investors have taken up trading as a occupation in our country now in the last 4 years.
What, according to you, is the conclusion? What is the intention behind the sending of this report by the regulator?
So the regulator is, discouraging intraday trades.
Okay.
They're saying that you should be looking at investing rather than intraday trades here. But the flip argument could be that, investing is a process and intraday trades can help you in learning the markets much faster as compared to of course you make losses, and that's why it gives you a very interesting number where it says that small traders account for, small traders means traders who have less than 5,000 average trade size, account for 47% of it, the bulk of it. And if you add between 5,000 and 25,000 average ticket size, it comes to nearly additional 26%. So nearly 80% of traders are those traders which are there. But it also gives you a very interesting thing, the trading costs. So people who are losing money in the market, 57% of the losses are accounted by trading cost. And people who are gaining in the market or making profits in the market, their profits have been reduced by 19% because of trading costs.
Right.
Which basically gives you a takeaway that the discount brokers are making huge money. Simple.
That is not the conclusion that I expected that we would draw, but it is an important conclusion nonetheless. That brings us to the end of this particular edition of the Editor's Cut. But there's more to talk about on the other side of this very quick break. Most importantly, we're going to talk about the latest F&O queues. And this, remember, is of course the expiry day. So you have to watch out for that. Do stay tuned. Lots more coming up.
Welcome back to India Market Open. We're now taking stock of the futures and options space in Indian equities. It was a tough day of trade yesterday. We perhaps could brace for another, a weak day of trade today as well. Yesterday was the Bank Nifty weekly options expiry. Today is the Nifty weekly options expiry. We're starting to see a considerable amount of longs being unwound as far as benchmarks are concerned, with the Nifty coming off by a little over 0.25% yesterday, the open interest declining by 20%, and it was the same for the Bank Nifty too, where the cuts were a little more deeper as compared to the Nifty, down by nearly 0.9%. In fact, at one point in time, the Bank Nifty was below the mark of 51,000, and yesterday's low perhaps could be an important support level to keep an eye on. If we lose that out, there could be a lot more weakness today. And there was unwinding coming in here as well. Open interest declining by around 17% there as well. Now, while we talk about the 25,000 mark as the one with the most amount of call open interest, I reckon that it's not going to be as relevant as perhaps something like a 24,600, 24,700 call and those specific strikes, because the range clearly has shifted downwards. On the lower end, 24,000 may just become a critical level at this point in time. Remember that the Nifty has been moving in and out of the 24,500 mark. So if we do in fact see sustained weakness in the first couple of hours of trade, and we continue to see the Nifty trade below 24,500, you never know what kind of an impact it could potentially have on price action. Of course, choppiness cannot be ruled out, but that's something that a lot of traders may want to bear in mind. Now, moving on to stocks. Again, yesterday's day of trade was where we did see a lot of shorts building up. A lot of stocks were in the red, a lot of them from the banking space. I'm not going to talk too much about unwinding, but that's just something that we're going to keep an eye on as we move into trade today. But the question really is positionally, how are you expecting trade to come through? Well, let's get an expert in. So we have Rahul Ghosh of Hedge.in who's joining us on the show. Rahul, good morning. Thanks for joining in. From last week until now, I reckon that a lot of your thesis has played out substantially. How are you looking at markets here on?
Good morning and thank you for having me. Yes, that would be correct. If you notice, for the last 2 weeks, we've been saying that markets are somewhere near the top, and the risk-reward ratio on the long side does not make sense anymore. And if you notice, 2 weeks back, we planned a bearish strategy on Bank Nifty, which has played out well and will further play out today as well, owing to the gap down. We planned a safe collar last week, which also, although early days, but is doing okay. We continue to have a bearish stance on the index in the month of August, and we're going ahead and planning a bearish strategy in Nifty. Also, one more point to keep in mind, that if you look at the last two instances where Nifty fell, I'm talking about the election time and a time before that, there was a sharp down move, and the very next day, Nifty rebounded. I'm talking about 4th of July and then 5th of July. Something opposite has happened this time, where there was a sharp rally this time, and then the next day you notice markets went towards the downside. So it's caught people unawares, where people thought, owing to the last two times, the same thing will persist, where Nifty goes down and then bounces back up. And that has basically trapped a lot of traders looking at the open interest.
Based on that, Rahul, what kind of an option structure are you deploying this time?
So this time we're sticking to something fairly simple. We're doing a calendar bear put in Nifty, a bearish strategy with low risk. What we're doing is we're buying the 23,800 put option of August end expiry. You can do this when Nifty gaps down as well, which is perfectly fine. I repeat, we buy the 23,800 August end put, and we sell the 23,500 September end put. Now, normally in a traditional bear put, you would be selling same expiries. The one additional advantage of selling the September expiry is that the credit we are receiving happens to be much more. So if Nifty were to stay sideways, or if Nifty were to move back up, the chances of getting back more amount of the debit and reducing your risk is why we are choosing multiple expiries in this. So buy 23,800 bearish side, sell 23,500 September, which is bullish side. The credit or the net debit in the trade, I beg your pardon, should be about 50 odd rupees depending on where Nifty opens. But your risk in the trade would be between 2,000 and 2,500 rupees. because the September expiry will not expire as fast or erode as fast as the August expiry.
Right. Rahul, for those who are relatively new in the markets, I reckon that the IVs have something to do with the strikes that you've chosen because of the fact that you've chosen a calendar and not specifically just one series. I reckon that the IVs in the August series are relatively higher. Is that why? Pardon me. Actually, why don't you go ahead and take me through the IV setup in this case?
So there are two Greeks that we're looking into over here. One is IV and one was theta as well. If I take the August 23 500 put, the theta effect might be larger because it's a closer by expiry, but the net premium intake is far lower. So it doesn't help me. So if there's a sharp move on the upside, let's say, the total premium I would make back would be negligible. Second, I'm sure everybody knows, or for your users who don't know, IV affects closer by expiries more than further away expiries. So IVs is already low around 12, 13. If IV were to increase because markets are going down, August would benefit more. That is, the August put leg would benefit more. And the September put leg would have a lower impact on IV. An IV would have a lower impact on the September leg. So in that case as well, an IV increase would benefit us. Plus theta also benefits us owing to the extra premium in the September sold put.
Well, there you have it. And that's the reason why Rahul is potentially choosing two different, expiries and not necessarily the same one to deploy this particular spread. But Rahul, on that note, taking a moment to thank you for joining us and taking us through this particular option structure. Rahul is bearish for now as far as the Nifty is concerned. That's something that we will continue to keep an eye on. With that, it's back to you, Samina.
Thanks for that, Agam. Quickly, of course, a check on implied Nifty to see what we're gearing up for this morning. It's going to be rough. Just like the weather in Mumbai, the markets are going to be hit by a painful start in early minutes of trade. 206 points lower is what the Nifty is pointing to, and it seems like there could be selling in the early hours of trade, and the markets will remain volatile for most part of today's trade. It's also the monthly Nifty expiry, which will keep traders on their feet. Nirav Asher, now head of equity research at Latin Manharal, joins in. Nirav, hi, good morning. Thanks for joining in. Nirav, it's looking bad for global markets. We've been dancing to our own tune for the last few days, but even our markets are showing signs of weakness and a little bit of disappointment from the budget. Earnings have also not impressed very much. Do you think we are already gone into a slow grinding correction that we've been fearing and talking about for the last few weeks or months now?
Yeah, good morning and thank you for having me on your show. Yes, I think there was this expectation that markets are going to go through some sort of correction, much expected. And I think it is taking shape now. And we've seen the expectations from the budget have not been met. There have been certain disappointments on the tax front. And I think Bank Nifty has been under consistent pressure. We've seen banking stocks quite weak in trade yesterday. And I think today, we'll have the IT sector, which is also under a lot of pressure. The global cues are extremely weak. So we should see weakness in the market. Plus, we've seen the IT sector run up quite fast. We've seen stocks like Infosys, which have moved up around 20% in the last 1 month. We've seen TCS up about 13% in the last 1 month. So I think correction is expected, and I think it should be healthy for the markets.
Right. Nirav, in that case, what have you made of those earnings? And I'll start with one stock at a time. Axis Bank. Numbers were a huge disappointment. Commentary is weak. Margins have deteriorated. Asset quality is a concern. And Bank Nifty already has gone into a correction from the start of July. How bad is it going to get for Axis Bank? And would you have a buy the dip strategy on Axis Bank? And if yes, what is the price you're waiting on?
I think we would stay away from Axis Bank at the moment because the numbers have been a disappointment. And I think while they are hoping that there is going to be a stable asset quality going forward and a stable credit growth and sustainable growth in the retail deposits. But I think that is more of a wishful thinking at this point of time. And I think I would wait for a deeper correction rather than jumping into this stock at this point of time. I think we would rather wait at this point of time. And there are better quality picks in the market as far as banking is concerned. I think our preference is more tilted towards HDFC Bank at the moment.
Well, Nirav, what is your assessment on Larsen & Toubro as well? This one, of course, will be in the long-term portfolios of many investors. What do you do with this?
So Larsen & Toubro was actually a positive surprise because they have said that in an election quarter they've done exceptionally well. I think the revenues were up by around 15% and PAT was up by around 12%. The EBITDA margin has been flat at 10.2%. I think this is largely attributed to the fact that around 48% of the revenues, total revenues in this quarter came from the international business. Apart from this, the company has guided that going forward, the EBITDA margins are going to come under pressure. They have cut the margin guidance going ahead because the international order book generally tends to have lower margins. And they have red flagged the availability of or the shortage of skilled labor, which could slow down the infrastructure projects. But overall, I think very healthy set of numbers. Plus, they have a very strong and a diversified order book. And going forward, more than 1/3 of the EBITDA is going to come from IT-related businesses, plus financial services and construction business, real estate business. So I think they are kind of de-risking themselves from the projects business also. So in a way, it's a very healthy outcome as far as the proxy of the India's infrastructure story is concerned.
Yes, you'd be a buyer, Nirav, I'd imagine, of L&T at the current price?
No, not at the current price. I think valuations are quite stiff, but I think it's there in the price. So we wouldn't want to buy at the moment.
Let's have Shrikant Chauhan now joining in with a technical view on the markets. Shrikant, the last few days have been slightly weak. The sentiment for sure, the breadth has not been very impressive. And this morning we are waking up to a gap down of about 200 points on back of weak global cues. If we do get a gap down of 200 points, is there a trade on the index?
Yeah, good morning, everyone. I think, the Nifty it's consolidating. After hitting the levels of 24,000, we saw some recovery, but the overall pattern of the market is indicating us that it is going to spend some more time within the range. And as it's a day,
I think we've lost Shrikant. We'll come back. I think audio issues, bad weather, all that contributing to that. But while we were talking about those two big earnings, let's quickly go over to Harsh as well. Nirav, of course, shared his view on Axis Bank with us. But Harsh is also standing by with what a whole bunch of brokerages have to say, what the commentary of Axis was like. Harsh, take it away. It's been tough. It's been tougher than what the street was expecting for Axis.
Well, clearly, we had highlighted two key aspects of Axis's results which were to be in focus. First off, on the NIMS front, the NIM shrink is not as large as possibly anticipated, but that's because of a one-off. In fact, when you're looking at the shrink, excluding the one-off, it's below the 4% mark. So margins below 4% expected to taper towards 3.8. They're going to try and control that taper is what the commentary seems to be suggesting. But the largest issue is with regard to the credit costs. Elevated credit costs, 55% of the increase in credit costs from that 0.5% to 0.97%, 55% of that is because of lack of recoveries in the corporate space. They're expecting that to unwind in coming quarters. You'll have to wait and watch out as to how much that unwinds. The second piece is with regard to unsecured. Out of the around 4,700 odd crore of slippages, 4,200 coming from retail. And that's the other concern. What they seem to be suggesting is that this is simply a normalization happening. And once recoveries start to offset some of these slippages, largely you'll start to see a taper and normalization. Therefore, they are not too concerned from a management commentary perspective, not too concerned. They are not, or they are suggesting that this is not suggestive of FY25 credit costs. So these are the two key aspects on the negative side. The third aspect possibly is the loan to deposit ratio. Deposit growth not coming through, 0% deposit growth. Lots of competition is what they are indicating, as a result of which deposit growth has been muted. They're not going to compete, unlike in the past. They're not going to compete on rates. So they're not going to hike deposit rates. They're going to protect margins. That's going to be the strategy going forward, and that they've absolutely clearly highlighted. They've said they will not increase rates. They'll protect margins. And that will get continued in the next cycle. That they believe will be a longer term strategy for Axis Bank. Last off, on the positive side, well, OPEX seems to be starting to taper. 27% is what the OPEX growth was in FY24. That is currently negative on a sequential basis, negative 2%, but that will taper in FY25. So that's one positive. So credit cost increase likely to be offset by that taper in OPEX. But ROAs have shrunk sharply, 15 bips of ROA shrink on a year-on-year basis, 19 bips on a sequential basis, sharp ROA shrink.
Harsh, it's not looking good, and I think markets are in no mood of being kind today, at least. It's going to be a weak beginning for Axis Bank. Shrikant, we'll come back to the Nifty closer to opening, but why don't you tell us what Axis Bank is looking like? A big gap down is expected on weak earnings. Fundamentally, it's a disappointment. Bank Nifty has anyway been weak. Do we have a strategy on Axis Bank on the short side today?
I think, like based on the overall performance in GDR, it will open down and somewhere close to then 1150 or 1100, the stock is having next leg of support, because there the stock has spent a lot of time when it was consolidating during the period of January, February 2024. So if we see the stock is dropping to those levels close to 1100, 1150, then there certainly we should look for taking some long bets, because again, we can expect some rebound. I'm not saying that again the stock will rally, but yes, it is going to remain range bound sort of in a trend. So close to 1100 levels, certainly we should look for taking some long positions. But at these levels, it is better to stay away. If we see the stock is opening somewhere close to its like around 1200 levels, then there try to take some profit or reduce long positions.
You know, Shrikant, I want to talk about L&T, but your quick view on the Bank Nifty, since you've already spoken about the Axis Bank as well. What are you doing with the Bank Nifty as well positionally?
See, positionally, Bank Nifty is also showing a weakness because it closed below the levels of 51,500, which is negative. Based on its technical formation and the way it underperformed to the broader market, I think this Bank Nifty is also heading towards the levels of 50,500. But as I mentioned that it's a day of monthly expiry, I am of the view that the Bank Nifty can take support somewhere close to 50,500 levels. So from there, again, we are expecting some rebound. Stocks like HDFC Bank, ICICI Bank, State Bank can attract some buying interest if we see the Bank Nifty is dropping to 50,500 levels. So close to those levels, certainly we should look for taking some trading bets with a stop loss at 50,200 levels.
Right. Shrikant, L&T has surprisingly surprised with earnings. Commentary also was very promising. But I'm mindful that we're going into a day when the sentiment is going to be weak on the street. In a case such as that, how does L&T look on the charts? If it does get a flat to slightly higher start, long trades could be initiated for the August series?
I think, say, like if we go through with the internals of L&T's result, then they are not as surprising as what we are seeing on the basis of their numbers. So I am of the view that we need to be careful. I think this stock can also correct back to the levels of 3,100 or 3,050 sort of levels. There the stock is having excellent support. In case if we see any higher opening because of this particular sentiment, then I think we should look for taking profit on long positions. I'm of the view that the stock is heading for 3,200 or at least 3,050 levels.
Okay, well, Shrikant, what about your picks which are there on your radar?
Yeah, I think I want to be more and more defensive in this particular market. I would like to go with stock like Biocon, which is around some 345, 348 levels yesterday. And in case if we see any lower opening, then it will be an opportunity to buy at lower levels. We can keep stop loss somewhere close to 329. I am expecting stock to move towards the levels of 370, 75. So broadly, I am expecting some buying interest in pharma companies. Also, we like Bharat Petroleum based on its technical formation. There also we are seeing range bound activity, but the way crude is declining and dropping from highs, BPCL looks a very decent candidate to buy at current levels. with a stop loss close to 299. I'm expecting stock to move back to the levels of 334, 340 in the near term.
That's the word on L&T as well. Nirav, SBI Life, we'll very quickly go through all the earnings we have and try and cover as much as we can. But SBI Life, Nirav, what were your thoughts? I believe the product mix was a disappointing one. And I think the fact that a lot of the business is coming from ULIP has kept a couple of brokerages on tender hooks. But your view on SBI Life and what is the strategy? If it's a tactical call, that'd be great.
Yeah, SBI has been a decent set of numbers, but I think, as you rightly pointed out, the product mix is a concern. But broadly, if one were to take into account the net premium income, it is up by around 15%, and we have the PAT which has grown by 36%. So I think taking into account the product mix concerns, I think we should be a little bit careful because I think most of the upside is there in the price at the moment.
Well, just...
All right. No, if there's anything else that you want to
just very quickly, if you have time, Shrikant, the quick trade on SBI Life, the trading range on the counter.
Yeah, technically the stock is into uptrend and it is forming high top, higher bottom series. So from here, the stock can move to the levels of 1730 or 1750, which is its next resistance level, and support is around 1575, 1600. So around 1600 levels or 1550 levels, look for taking some long bids.
Okay, well, on that note, we step into a quick break, but also let's hear the views coming in from Neelkant Mishra on why he prefers buying bonds over equities, and Samir Arora on his market strategy post-budget.
The equity risk premium in India is at a ridiculously low level. So well, I've been saying that for 1 year, so just that disclaimer. And that I would be better off buying bonds today than equities, given that the expected reward on what is supposed to be a much more risky asset class, which is equities, is not commensurate to the risk that historical returns suggest.
On a post-tax basis, India will become less attractive. India has done well on a pre-tax index level. If you look at just index level performance of India versus other countries, but if you put a 15% tax average, let's say whatever, some number, and then you compound with that every year, that's every year you're paying some long-term, some short-term, and make whatever assumptions you want to make, then it will not look as well. It might still look better than many countries, but then it will depend on phases, because last 5 years India has done well, China has done badly, this, that. But over time, your attraction by definition has to come down a little. The most amazing thing I found yesterday was that people were talk about earnings changes of 1%, and that in an IT company, the bottom of the range has gone up by 0.5%, and therefore that will change EPS by 2%. And therefore, people write research reports of 20 pages of this. But when you hit the earnings of the investor, which is the end result of all that research you were doing, by 4-5%, they say it doesn't matter. But 0.1% change in earnings matters.
welcome back. This is India Market Open. Well, we want to talk about the EMS space. I'm going to take this question up with Nirav. The reason why I want to talk about it is that firstly, we've seen some very strong earnings coming through. Today, of course, we have PG Electroplast, which has in fact seen a doubling in revenue, and its profit has grown as much as 145%. That said, we also have some of your relatively larger names which continue to show momentum towards good earnings. So you have Dixon Tech, you have Keynes Tech, you have something like a Surma Technologies as well. Of course, a mixed batch when it comes to the products towards which these companies are catering to. But Nirav, your overall assessment of the sector, are valuations becoming heady?
Yeah, I think the performance in this particular space has been very exciting as far as the revenue growth is concerned. The revenue growth has been quite exciting, but the sore point is the margins. So we don't have high quality margins which can reflect in net profitability or strong cash flows. So I think that would be a cause of concern. But I think over a period of time that is also likely to materialize, because we'll see all kinds of operating leverage, etc., beginning to kick in. But I think at this point of time, the revenue growth has been very, very satisfying. But as you rightly pointed out, the valuations are on the higher side. I think most of these stocks trade at PE multiples, which are very, very crazy, in the range of 80 to 100 times or more than 100 times also. So I think would be a bit wary and cautious as far as these stocks are concerned.
Well, Shrikant, on the charts, PG Electroplast, Dixon, they've been on a little bit of on the sell side, at least post the budget or just ahead of the budget as well. But anything in that space you like, in the EMS space? Shrikant, you're on mute, so we can't hear you.
Yeah. Sorry. I think like PG is still showing a lot of strength, and means it is relatively better than other stocks based on its technical formation and the way the stock has spent time between the range of 450 and 400. I am of the view that the stock is heading for at least 500 sort of levels in next few weeks. It will take some time, but because the stock has already spent some time, it's a buy if there is any correction. Right now it is showing some 455 sort of levels, but if there is any correction, let's say close to 410 or 415, then there we should look for taking some long bets. But for Dixon Technologies, I am of the view that it is very close to its long-term resistance levels, and after hitting those levels, now it is reacting to the support levels, and supports are somewhere close to 9500 levels, which are far away from current levels. So it is better to stay away from taking any specific bets or any specific trade on Dixon. In case if there is any rebound from current levels, then try to reduce position around 11,000 or 11,500.
Right, that's the word coming in a couple of the stocks. We are into pre-open. A quick check on how the index is expected to open. Not as bad. Actually, yeah, not as bad as we'd have thought. It's only 1% low on the Nifty 50, so we're still doing better than the rest of the world, or at least in terms of the handover we had from Wall Street. A start closer to 24,100 is what we should be expecting. A quick check on Bank Nifty, Axis Bank, L&T, SBI Live. Those are going to be some of the movers that will give direction to the markets and trade. Axis Bank from the get-go is indicating to a 5% downtake. SBI Live doesn't look too bad. You've got L&T that should be getting a positive start. Interesting to see how consumption names play out today after seeing a little bit of profit taking yesterday in trade. Actually, Shrikant, why don't you come in on this? Consumption was looking good on the charts. So Tata Consumer, Godrej, ITC, just into the budget or even on budget, they had a very strong run, and yesterday the day belonged to profit taking. Today, how do these look? Do you have a constructive call on any of these names today?
See, most of these stocks are very close to their resistance level. ITC was around 500 levels. From there, all the way back to the levels of 490. So this type of trend is not ruled out at these levels. But yes, in this particular space, we like Marico, we like Hindustan Lever based on their technical formation. I think if we see any correction in the near term in these stocks, then there we should look for taking bets, because they have spent considerable time within the specific range, and now they are breaking out of these levels. So yes, if there is a medium-term view, I mean to say view of next at least 1 or 2 months, then there certainly we should look for adding stocks like Hindustan Lever as well as Marico, and we also like ITC. But yes, for that we need some correction from current levels around 480 levels. It's a buy.
Right. Neerav, you want to come in on buying consumption? Does that space look good? Bikaji today reported numbers that are very solid, but that seems to be an outlier for now.
Yes, I think if one were to pick up the winners from the union budget, I think it was the FMCG sector and the jewellery sector. So I think if one were to look at the FMCG space, then HUL, and we particularly like Dabur because of its exposure to the natural and the Ayurveda space. And I think they've been ahead of the curve as far as the investments in brand building, advertising, distribution, etc. is concerned. They've spent quite a huge sum of money on all these segments. And I think now it is the time to reap the returns because their distribution strategy has grown quite fast. And I think most of these FMCG companies, their e-commerce segments have been doing quite well. They have a very good exposure to the modern trade as well. So I think it's going to be an exciting time for FMCG companies, especially the likes of HUL, ITC, Dabur, Marico, etc. In the jewellery segment also, I think with the reduction in the customs duty from 16% to up about 6%, I think augurs well for jewellery makers like Titan. And we've seen yesterday some very good movement in Kalyan Jewellers. So I think the consumption space is definitely looking exciting, especially in the light of the upcoming festival season and the wedding season.
It's interesting that Neerav spoke about the jewelry sector because that's exactly what I wanted to take up with Srikanth as well. So we've actually had a relatively stronger move in Kalyan Jewellers as compared to perhaps Titan or Senco. Anything that stands out for you, Srikanth, in this case? Do you think that there could be an opportunity here in any of the three names that we are considering right now?
Yeah, I think technically, I would like to go with Titan because there the technical pattern is relatively better. No doubt that we saw spectacular rally in Kalyan Jewellers, but it is now very far from its important support lines. So in case if there is any correction, then traders can look for it. But I think Titan is something which is showing some relatively better strength. It has formed double bottom sort of formation, and this specific news flow from the budget is positive for the stock. So even though fundamentally the company is a little bit under pressure, I think this news flow will help the company to do well in the near future. Close to this 3,400 levels, it's a buy. I'm expecting stock to remain in a range of, let's say, 3,800, 3,700 on the higher side and 3,200 on the downside. So downside is limited. It's a buy at current levels and more on dips.
Right. Neerav, chemicals are seeming to be making a comeback. Yesterday, stocks like Archean did quite well without any specific news trigger. Do you think it's now, given that we have seen sectoral rotation, do you think chemicals could be the flavor for the next couple of weeks? And if yes, any recommendations here?
Yeah, so I think it's been a deep and a painful time for the chemical makers because there was an issue relating to muted demand. In some companies there was problem relating to high inventory stock in the channel. So now most of the channel inventory seems to have been cleared, and we've seen the destocking exercise virtually complete. So most of these chemical companies have started giving positive guidance. They expect things to improve in the second half of FY25. So I think hopefully they should have a recovery time once the destocking in the trade channel is over. And fresh inventory will come definitely at better prices, and we'll see the demand outlook also improve going forward.
All right. Well, there you have it. That's as far as the chemical sector is concerned. I think if we do have a chance, we could perhaps go across to my colleague Puneet, who has a broking note this morning on Tata Motors. Puneet, over to you.
Yeah, thanks for that. So a big upgrade coming in from Nomura on Tata Motors. They've upgraded the stock from a neutral rating to a buy rating with a target price of 1,294 rupees per share, which they've raised from roughly 1,191 before. Now this implies an upside of roughly 26 to 28%, and they have mentioned two key divisions of JLR as well as the commercial vehicle being one of the triggers for the positive upgrade. Now they have mentioned that JLR is embarking on a luxury journey going forward and a luxurious ride as well. They have mentioned that JLR's execution can lead to significant upside for Tata Motors, and that's where the positivity is coming from. They're expecting the earnings growth for the JLR division to be substantially higher this particular year due to rise in average selling prices as well as margins going forward. They expect JLR's EBIT margins to come in at 8.5% for this fiscal year of 2025 versus 7.8% last year, and are expecting this to go to lower double digits by FY27 as well. Mentioning that JLR's EV transition as well as the premium focus of brands such as Range Rover will lead to both average higher selling prices as well as margins going forward. They have raised the target multiple for JLR division specifically to 3.5 times its EV by EBITDA. This is up from roughly 2.7 times. And specifically on the India PV division, they have mentioned that the launches of Curve on July 7th as well as the Harrier EV in this particular will also support the domestic PV growth. When you look at FY25 estimates for Nomura, they have mentioned that demerger of the commercial vehicle business will also help the higher multiple for the CV division, and they've raised the target multiple for the CV space as well to 11 times EV by EBITDA from 9 times before. So overall, these two divisions is what Nomura is most positive on. While expectation of PV's sales growth is flat, these two could drive growth going forward. Back to you.
Right. Thanks for that. It's a big upgrade coming in for Tata Motors from Nomura. The stock is trading marginally higher, at least in pre-open trade. Well, a couple of other ones that we'll be tracking in terms of earnings. Shrikant, on the charts, JK Paper, Sona, BLW and Craftsman Auto.
Yeah, I think JK Paper is showing some bullishness on charts, but at the same time, based on its overall performance in this particular quarter, I think we could see some lower opening. Close to 500 levels or close to 490 levels, the stock is having support, but we need to see that whether it is recovering back or not. So on daily basis, it was around some 300 levels in the month of April. From there, all the way it moved back to the levels of 600. It doubled from lower levels. So till the stocks are not correcting to their important supports levels, like let's say 450 or 460, it is better to stay away from taking any specific bet with a near-term view. If there's a medium to long-term view, then I think close to 490, 500 levels, we should look for taking some buying interest in the stock with a view of adding more if there is any further more correction. For other stocks, I think currently most of these stocks are falling from their highs, and it is better to stay away from taking any specific bets for the time being.
Nirav, just very quickly, the same three stocks, Craftsman Auto, weak numbers, margins were down, stocks down 4%, JK Paper having it rough for I don't know how many quarters now, and Sona BLW stands out, decent numbers. On the three that I mentioned, anything that you like and what you dislike?
I think JK Paper has been under pressure because the entire paper segment has been affected by the falling realizations and the muted demand. There's been a sharp increase in the raw material cost that has hit the margins. So there was a huge dent in the margins, and I think that continues. And yesterday we had a poor set of numbers from JK Paper. Hopefully things should improve going forward, but I think as far as the demand is concerned, the school demand is already over. The schools have already reopened. We are seeing office demand quite modest. And going forward, the packaging board segment should do well, especially during the festival season. So I think recovery is still some time away as far as JK Paper is concerned. As far as Sona BLW is concerned, I think they have a very strong order book, but the stock is very, very expensive. I think the order book is around 7 to 8 times its FY24 revenues. But the stock is trading, even if we were to discount it by 25%, the stock traded at approximately 38 times its FY27 earnings. So I think it's very, very richly valued. So I would like to stay away from this. And Craftsman Automation also a similar problem. We've seen a poor set of numbers, and I think it's better to stay away from the stock for the time being because valuations are very, very stiff.
Right, Shrikant, we just have about less than a minute left. Your view on the Nifty on an intraday basis and positionally?
I think, say, like with an intraday view, we should be look buyer if there is any like furthermore weakness after opening these levels, because 24,200, 24,150 is going to act as major support based on their option statistics. So there is huge amount of option writing is lined up close to this 24,000, 24,100 levels. I'm not expecting Nifty to break the level of 24,000 so easily. So it's a decent risk reward ratio for intraday traders to take any position. For a medium-term view, I think it is going to spend time between the range of 24,700 and 24,000. On the basis of dismissal of the range, we can see the overall trending activity. But yes, in case if there is any closing below the levels of 24,000, then the chances of hitting 23,000 will be good and bright.
Right. And it's expected to start in a few seconds. And it doesn't look as bad, remember viewers, from as bad as the world markets are doing. The Nifty may not be getting such a bad start at the get-go. Under 1% cut is what the expectation is. That's it. It's looking far better than what the rest of Asia or Wall Street was doing. 0.7% off on the Nifty. 24,200 will be a key level of support that the Nifty will find support at. Well, the Sensex also down 0.5%. So we're off the day's low point already from the look of it. 146-point cut is what we have in the index. Bank Nifty is down another 370 points. Now we're sub 51,000 on Bank Nifty. Remember, it's the monthly Nifty expiry as well. So there will be some volatility in the second half of today's trade. Well, in terms of the breadth and the Nifty movers, let's quickly take you through what we have. There is a small chance that the broader markets would be doing worst off, and that's exactly what's happened. Even though the earnings reporting that came in from the broader markets was better than what the street was working with, the mid cap is down 0.8%. The small cap index also sees a cut of about 0.8%. Let's take you to the Nifty 50 movers in today's trade, and that is the breadth, and that's weak to say the least. You've only got 5 stocks on the Nifty 50 that are trading positive. The rest of the whole market is a sea of red. SBI Life post its earnings is up 2%. L&T numbers were strong. Management commentary was strong. The stock is up 2%. Tata Motors on back of the Nomura upgrade is up 0.8%. Defensives that sold off yesterday are trying to find their feet. So Nestle and HUL are trading marginally higher. On the sell side, Axis Bank takes it to the chin. The numbers were weak. The guidance was not too promising. The stock is out down 5% in trade. Shriram Finance looks weak. OMCs are having a weak day. You've also got tech that's down and out, largely on the way Nasdaq performed in overnight trade. Pharmaceutical counters are also trading lower, and banks as a pack, along with metals, are seeing some weakness. So you've got 5 out of the 50 Nifty stocks. Only 10% of the index, Agam, is in positive territory. The rest of the markets are selling off quite badly.
Yeah, that's actually the case for the broader markets too, Samina. We haven't seen too much change with respect to the broader markets or for that matter, how things are panning. So this is your mid-cap index that's down around 1%. And, well, clearly it's seeing a little bit more weakness as compared to the Nifty. The small cap index moving in tandem with the mid cap index. So let's take a look at all the stocks. Now, we've had more hits than misses when it comes to earnings as far as, your Q1's concerned. I'm going to start with some counters which in fact did come with strong earnings. So we have Bikaji Foods, Oracle Financial Services, Hitachi Energy. We're looking at strong top-line growth, strong operational profits coming through. But at least 2 of these counters, as you can see, are under a tad bit of pressure in the morning. Hitachi Energy down 2%, and Oracle Financial Services also down by as much. But we have more strong earnings, and this time around, for this particular set, Trident, HFCL, and Mass Financial Services currently trending in the green. We shift focus to the auto ancillaries then, which also came out with our earnings. Sona BLW numbers were good. Craftsman Automation numbers not so much. And that's the reason why we're looking at a knock around nearly 5% as far as Craftsman Automation is concerned. Sona BLW on account of relatively stable quarter is advancing by around 1.3%. And let's not forget, there are other counters which are also in focus. Mixed earnings. The JK Paper, of course, looking at a knock of around 7%. We had quite a decline as far as its bottom line is concerned. IGL looking at a decline around 2.5% as well. Karnataka Bank, on the other hand, stable numbers, but there is a little bit of problem when it comes to your gross NPAs and your net NPAs. But still, we're seeing an up move around 0.9%. On the whole, the broader markets moving largely in tandem with the benchmarks, and the advanced decline ratio not nearly favorable. In fact, we're looking at just one gainer for nearly 9 declines at the moment, Samina.
So it's looking bad, and I think that's probably a number of factors, right? It's a cocktail of factors: weak earnings, overvalued markets, the budget being a little bit of a disappointment, weak global cues. So nothing much for the markets to hold on to except liquidity maybe. And FI selling is what's leading to the markets looking weak. We started off lower, but we seem to be grinding further as we see it from the get-go this morning. A few more stocks to add to Agam's broader market list that are having it bad. Thing is highlighted pretty much everything, but RBL, I think the block deal could have happened, and that's why the stock is down 4% in trade. You've got Kajaria Ceramics that's down. Suraj Estate, if we can pull that one up, it was looking good in trade. PG Electroplast, those are a few more that have managed to eke out strong performances. So those counters, seeing PG Electroplast up 12%. And that's what a strong quarter does for a company like PG. 11.7% high on PG Electroplast. Take a look at Suraj Estate. Let's see what that's getting up to in early minutes of trade. It was up 5% when I last checked. Should be doing quite well as we see it. There you go. 5% circuit on Suraj Estate is what we have. Well, auto ancillaries are doing well. So, no, actually they're not. Ramakrishna Forging is down 2.5%. Sonata Software, IGL, Max Healthcare are some of the other big losers. Hospitality also seeing some selling in today's trade. On the gaining side, MMTC is up 11%. Sri Renuka Sugars are 4.5%. Suzlon, very strong earnings yesterday. The markets continue to reward the counter. It's up another 5%. Recruitment companies like Quest and TeamLease continue to gain in trade today. V-Guard, good earnings. The stock is up 3%. Kalyan Jewelers, there was a buy call by our guest as well, is up in trade 2.5%. Sona BLW is up 2%. Trident is not doing too badly despite weak earnings. Avanti Feeds continues to see some buying today. And Syngene International also trading with a positive bias. Shrikant, you want to come in on this? How do you feel? The markets have opened up with an 0.8% cut. 24,200 is being respected. Any opening trades for intraday?
I think, see, it's a monthly expiry date, so I am of the view that we should look for taking intraday long bets on the Nifty between these levels. I'm going to say from 24,225 to let's say 24,175 with a stop loss close to 24,000. I'm expecting again rebound in the market. It will take some time. It will consolidate furthermore for few hours, but later we are expecting some recovery. Bank Nifty is also very close to its important support levels of 50,500. So there also we are expecting pressure to ease somewhere close to 50,500 levels. And most of the stocks like HDFC Bank, ICICI Bank, even Reliance Industries are very close to their important support levels. So for the day specifically, I am of the view that it should recover back in the second half. That's the overall view. But stock specific, as you discussed, like Tata Motors, SBI Life, they are really doing well. I think we can expect further more activity during the day from these stocks.
In fact, the breadth in the last 2 to 3 minutes since we chatted has already improved. So first, you had only 5 stocks that were looking okay, but the likes of an NTPC, Kotak, Bajaj Auto, HDFC Bank are now turning positive. So maybe a recovery in the second half is what we are betting on. Hopefully, fingers crossed for now. Need of 2 stocks, Quest Corp and TeamLease. Of course, with the budget, big push on employment and improving scalability seems to have helped these counters, at least in stock performance. Do you feel like, I know the government's plan is a 5-year plan, but in the near to medium term, Quest Corp and TeamLease could be good stocks to add to one's portfolio?
Well, I think at this point of time, it's play on momentum. So I think it's better to wait for some correction as far as Quest Corp and TeamLease are concerned. But we have a coverage on NIIT Limited. I think we are more excited about the prospects of NIIT going forward, particularly from a skilling point of view, reskilling point of view, as well as upgradation of overall skills. And I think slight uptick in the IT space also should benefit them. So I think overall, all these firms have decent prospects going forward.
Nirav, I also want your view on a handful of these public sector financial companies. So you have the names like Hutco, you have names like Ireda. REC, PFC. What's actually been observed is that while they continue to move up through the months of June and July, they're now seeing a bit of consolidation. How are you looking at trade in terms of investment as far as some of these names go?
Yeah, so all of these companies have a long-term goals and bets, and their performance is closely linked to the fortunes of the power sector. For example, PFC, REC, basically they have been funding a lot of renewable energy projects and other types of projects like thermal power projects. And with the outlook for the power sector being so good, I think these companies should continue to do well. At the same time, IREDA is also focused on renewable energy, and we know that approximately 500 gigawatt of renewable energy is likely to get added by 2030. And the share of renewable energy is going to be quite substantial in India's energy mix. So I think the prospects for IREDA also continue to be quite strong. Woodco, I think their tie-up with the Gujarat government for financing of the infrastructure projects, I think it's quite an early story, and the valuations have run up quite a lot. So one needs to be a little bit wary over there.
Right, be wary, and I think that's a fair way to read this market. Hutco is up about 6%, 2% as we see it. So you've got a few gainers in trade, but not significant enough just yet to change the sentiment that is on the market. A quick check on RVNL if I can. The reason I'm bringing that up is because they've actually seen a big order win to the tune of about 200 crores. Stock is not doing too much on back of that. Metals are down 2%, IT is down 0.6%, consumption is trading flat. But I'll quickly take a call on Suzlon from Shrikant. Suzlon, Shrikant, yesterday 5% today. Opportunity to go in, you think, for the short term?
No, I think, it is now very close to its important extension levels because the stock is in completely new range. It is crossing all its important levels on a day-to-day basis, but at the same time, it is far away from its important support levels like 45, 47. So I am of the view that based on next extension levels, we could see the levels of 68 or 69. There the stock is ending its largest up move. So close to these levels, we need to be careful. I think from there, we could see some correction. At this level also, it is completely into overbought territory. So in case if we see any correction close to 55, 56 levels, then certainly it's a buy with a trading point of view or with a medium-term view. But at this level, it is better to stay away from taking any specific bait.
Yeah, of course, Suzlon has been hitting, moving at highs. Of course, there's a lot of change with respect to sentiment in the stock. To a certain extent, fundamentally, things have also changed as far as Suzlon is concerned. But I'm going to stay with the energy theme. So while we have addressed the energy financiers, let's talk about some of these stocks which are focused towards renewable. You have something like a Borosil Renewable, which actually did advance substantially yesterday. And remember that it has been moving upwards on account of the outcome with the union budget. The basic customs duty has been increased when it comes to some of those components which go into solar manufacturing, solar panel manufacturing. Nirav, any view out here, any potential opportunities, not just in Borosil Renewable, but maybe some other names as well, which actually cater to the renewable sector out there?
Yeah, so there was a genuine risk of dumping from China and the focus on indigenization. And I think that has prompted the increase in the basic customs duty to promote indigenization. So a lot of companies have been working on all these components for solar, especially the likes of Borosil Renewables or Adani's. Reliance also has got their in-house capabilities. And I think it's essentially a work in progress. So I think the right step at the right time, but it's a long-term story.
Well, the markets are now at 24,241 on the index. The bread's gotten better. Auto is not doing too badly, surprisingly. Stocks like Bajaj Auto are trying hard to turn positive. Anything else, Shrikant, you've identified for trade this morning after what we've seen in opening, because there are a few counters that are trying to stage a recovery.
Yeah, I think this Tata Motors is showing a lot of strength. It is it was consolidating within the range of 1,035, 1,040 on the higher side and 980, 970 on the downside. But this time, the way the stock is absorbing selling pressure close to 1,030, and now after this specific report on the stock, I am of the view that technically as well as fundamentally, the stock is showing a lot of strength. Yes, on immediate basis, it has resistance at 1,065. But broadly, I'm of the view that the stock is heading for 1,165. So even at these levels, it's a buy, somewhere close to 1,040, with a stop loss around 1,010. We can expect 1,100, 1,165 on the higher side. We also like SBI Life, where the numbers were better than expectations. But at the same time, if we see the technical pattern of it, then it is crossing its swing high. And overall sector is also doing well. So here also we are expecting stock to move towards 1730 or 1750 in the near term. So SBI Life as well as Tata Motors should be on the watch list.
Look at Ramakrishna Forgings. Earnings were not bad. See, the stock has reacted to that. It's down 2.5%. Aditya Birla Sun Life, again, profits have jumped, revenue has risen, while SBI Life has it good. Aditya Birla Sun Life, if you can pull that up on the screen, we should get a sense of how the stock is doing. IEX as well reported good earnings. So I think IEX is another one that could be doing well in early minutes or early ticks in trade. 2% high in IEX on back of good numbers. Nirav, I don't know whether we talked to you about your stock recommendations. Anything that you like, you're constructive on, that are your top 3 bets in the market at current prices?
So we like Reliance Industries, we like HDFC Bank, we like Ambuja Cement at this point in time. In the small cap space, I think we like HCC Hindustan Construction Company because there has been a lot of focus in this budget on the pump storage scheme and the nuclear power projects which are likely to get revived. And I think HCC has a very big exposure to nuclear power plants. At the same time, they have their expertise in hydropower. So if they are able to get their act right and execution right, then I think this stock can definitely go places.
Okay, well, there you have it. That's the view on HCC and, of course, in the infra pack. But on that note, thanking both our experts for joining us and taking us through their views on the markets and, of course, giving us a handful of ideas to work around with as well. Remember that for now, at least as far as the first 15 minutes of trade are concerned, there's been a little bit of an improvement after the first tick, but the markets still remain under pressure. But there's been a lot of recovery in a whole host of broader market names, and the advanced decline ratio has in fact improved in the first 15 minutes of trade. But that's something that we'll continue to give you an update on. We slip into a short break, and on the other side, we speak to the management of Petronet LNG's AK Singh. Stay tuned, and we'll be back in just a bit.
welcome. You're watching India Market Open. It's a rough morning. So is the weather in Bombay City, where it's raining, and the markets have also been hit by a little bit of a cut on back of weak global cues being overbought, and of course a whole bunch of earnings that may or may not have met street expectations. The Nifty down about 150 points, but off the day's low point for now at least. Well, we have with us a very stalwart from the industry joining in. AK Singh, MD and CEO of Petronet LNG, is talking to us to tell us about how the quarter has been and what the outlook for the company is. Hi, Mr. Singh. It's Samina from NDTV Profit. Thank you very much for taking the time out to talk to us. It's been largely a good quarter for Petronet LNG. Your margins have improved significantly in this quarter. Can you tell us what led to the margins going up, and what sort of margin expectation do you have for the rest of the year?
Yeah. Good morning to everybody. Let me first express my gratitude to NDTV team for inviting me to share my insights on the Petronet LNG Limited and particularly the gas and LNG market. This quarter indeed has been best ever quarter in the history of Petronet LNG, and the Dahej terminal during this quarter has processed highest ever daily throughput, even monthly highest ever, and the quarterly also. We processed 248 TBTU from the Dahej during this quarter, and overall quarter volume including the Kochi, it was 262 TBTU, and compared to the previous quarter, which was 234 TBTU and the corresponding 230, the growth was in the range of 12 to 14%. So the volume growth was very high with reference to the previous operations of the terminals, and we operated average 109% Dahej terminal, and in one of the months the operations was even 115%. So going forward, definitely if the prices remains in the range of $10 to $12, which is hovering right now, the spot and even the long-term prices are in the same range, we expect that this volume growth will continue, and definitely this quarter was having more demand of the power sector, but coming forward there are other industrial demand also growing because of the economic activities picking up in the countries post-COVID, and as we know that the GDP is increasing in the range of 7 to 8%, and even industrial activity, even the population is moving towards the city area. Lot of gas demand is coming, and our expectation is that we will continue this robust growth of the volume in the coming future also.
Right. Sir, congratulations, and it's a complete pleasure to have you talking to us and telling us about how it's been for your company. So while we completely understand it's been great, margins are growing really well, revenues were slightly soft. Now, is that because there has been a little bit of pressure on pricing? And also give me an understanding and sense of what the LNG price trajectory is looking like going ahead.
Let me first explain how the revenues is earned by the Petronet in their entire business. Around 85 to 90% revenue, which is linked with the international LNG prices, are passed through to our off-takers and the customers, and mainly our revenue, which is in Indian rupees for the regas services which we provide, are around 10 to 15%. So when the international prices of LNG changes, our revenue also varies with that, and that is the reason there is a slight reduction with respect to the previous quarter, the revenue, and the reason is that even though we have processed more volumes, but our long-term volumes, which is we are doing trading from the Qatar and the Gurgaon, Australia, which accounts for around 9 million tons of the total volume we handle in the year, there was some less volume process for the trading volume, and the prices is not added in the revenue for the trading volume, whereas the service cargo, which is for the servicing of the regas charges, it has increased. So overall impact was slightly lesser than the previous quarter because of these two major factors.
Right. Mr. Singh, if you could also give us an idea about how volumes are shaping, how it was in the quarter gone by, and what can we expect when it comes to this entire financial year?
So, of course, this quarter has been the excellent quarter in the history of Petronet, where we have processed highest ever volume. But our expectation is that going forward, the volume growth will improve. I will give you some example that even the 3 to 4 years back, the country was using almost 26 million tons of imported LNG. However, during the COVID period and this Ukraine and Russia war, this volume decreased to even 20 million ton, then it has picked up to 22, 24, and now this year it seems that it will be definitely going beyond the previous, the earlier 4 years back volume of 26 million ton plus. In fact, I will share one data of May this year where the LNG share of total natural gas in the country has grown to 54%, which was normally in the range of 46 to 48%. And total gas consumption in the country was 213 MMSCMD as per the PPAC data. So there is a substantial increase in the gas consumptions across the board in the country, particularly the refinery sectors which used to use the liquid fuel is now switching over to the gaseous fuel. The CGD networks are expanding and day by day the volume is increasing. And going forward, if the prices are stable, definitely in power sector also it is expected that quite a large quantity of gas can be consumed in our country, because we have almost 25,000 megawatt installed gas-based power plant in our country, and it doesn't operate because of the high prices of the gas. And whenever the prices comes a reasonable level, these gas turbines comes on a stream for meeting the peaking power requirements. And all indications are there that in coming days, the gas consumption in our country will be improving only.
Singh, I also wanted to understand about LNG trucking. What kind of an opportunity do you see here?
See, Petronet LNG also is playing a pivotal role in this business of trucking business. We have already installed and completed 4 stations, 3 in Tamil Nadu and 1 in Karnataka. And 1 we are going to put up at near our Dahej terminal. And we have already planned to set up 10 more stations in this fiscal year. And other OMC also in this business of setting up the more stations. And if you compare with the China model, where during last 4-5 years they converted 4 to 5 lakhs long hauling trucks and buses operating on LNG, they are consuming almost 10 to 12 million ton per annum of the LNG in the transport sector. And there is no reason why India cannot achieve this target of increasing the volume in the trucking system, because it is going to be a environment friendly fuel. It is going to be a cheaper option than the diesels. And this LNG long haul trucks can travel almost 700 to 1000 kilometers in one field. So government of India is also pushing a lot on this sector, and Petronet wants to be the leader in this business also, because we have a unique advantage of storage of LNG in the country. We have 2 existing terminals, and we are in the process of setting up the East Coast terminal at Gopalpur. So with these 3 terminals, we will be able to serve across the country in around 1000 kilometer range, anywhere the dispensing station is set up, and continuity of supply can be ensured. So, of course, in the coming futures, this is a growing sector where we expect a large increase in the volume and also in the business of the Petronet.
Very lastly, Mr. Singh, we'd have loved to chat with you longer, but unfortunately short on time. What are your capex plans and capacity addition plans for FY25?
As we have said in the past also, we are in the process of expanding our Dahej regas capacity from existing 17.5 million ton to 22.5 million ton. And we are targeting to complete this expansion by the end of this financial year. This is a very low capex expansion plan we have undertaken. And this will give a lot of leverage of utilizing our Dahej terminal. We have seen during the peaking period in this quarter itself, the terminal had gone operation up to 22.5 million ton on some of the days. So there is a requirement of the capacity at the Dahej, and this is on the fast track. This project we have undertaken. Coming to that capex plan, we have already got almost 30,000 crores of the board approved projects at different stage of executions, and the main being the petrochemical complex at the Dahej. All the capex plan are on track, and our petrochemical complex where we have already engaged the licensors, we have appointed the PMC, we have a land, we have the environment clearance, and we are going ahead full-fledged to complete this project as per the schedule target to complete by October 2027. Also, the Gopalpur terminal also, we are going ahead full-fledged for completing this terminal in 3 years' time. And this 2 tank, I would like to share that which we undertook 3 years back. This is getting commissioned well before the scheduled completion date of 3 years. As per the schedule, the mechanical completion was scheduled in September this year, but we have already completed mechanically, and it is going to be commissioned very soon. So this 2 tank is going to give a lot of leverage in our future business, where we can arbitrage our margin when we have a better storage capacity.
Right. Thank you very much, Mr. Singh. Great talking to you. Good luck with business, and we'll hopefully chat with you soon.
Thank you. Thank you. Thank you very much.
On that note, we'll take a quick break. We'll come back. We'll put the focus on KPI Tech. Their earnings have beat street expectations. All that and more on the other side. So stay tuned.
Good morning and welcome to NDTV Profit. My name is Rucha Sumaya and today we are going to discuss about KPIT, which reported its first quarter results. Numbers were largely in line. Revenue was up around 4% while margins a tad higher than the last quarter at around 17.5%. And today we have with us Mr. Kishore Patil, the CEO and MD of KPIT Technologies. Good morning and thank you for joining us today. I'll start with taking your views on the inline numbers that you've reported for quarter one.
Yeah. So good morning to you. See, we have, let me just put it in a right perspective. Year on year, we continue to grow by 24.8% in constant currency, the revenue year on year. And the PAT has grown 52.4% year on year. So that's a pretty significant growth in the current environment. And if you look at the EBITDA percentage, we are, as you mentioned, it's a little higher than the last quarter, in spite of additional expenses in terms of ESOPs, which we have given during the quarter. So overall, we have been in a position to achieve margin expansion during a difficult quarter. Year on year, EBITDA growth has gone up by 31%. So this is the 16th quarter of continuous growth in profit and top line. And the key point I may want to tell you is in this 16th quarter, our revenue has gone up by 2.5 times and the profit has grown 4 times during the same time. So it's a consistency which we have been in a position to deliver is what is great. Naturally, we are doing all our efforts to make it continue.
Right. Also on the guidance front, which is very important for IT and as well as an ER&D company, you have maintained the revenue growth organic guidance at around 18 to 22%, as well as the margin guidance at more than 20.5%. But as you rightly said, despite the ESOP cost and the promotional expenditure, which might weigh heavily on the margins, what other levers do you expect to maintain this kind of margin for the year?
See, I think the first quarter we have done pretty well. The second quarter, we are going ahead with our normal increments. We are not postponing. We are giving a normal, as always, best in line increments. Also on the ESOP cost, we will have a higher ESOP cost in the next quarter. So in spite of this, typically if you look at 2.8% additional expenses during the Q2, we have maintained the guidance both on an outlook on the top line and the profitability. So I guess it will be driven by the growth, operational efficiency, which we are bringing. And of course, I may say some of the high margin deals which we will be in a position to deliver. So basically, these are 2-3 points by which we will be in a position to achieve the margin.
Right. Okay, so let me just move on to the geography-wise breakup. You get around 28% of your revenue from the US, but US was a tad softer this quarter around. It actually degrew sequentially. You'd also mentioned about the challenges with the OEM trucks. So can you give us some more highlights, and by when do you expect the US segment to see a pickup?
So first, I want to give you the overall view. We believe Asia will be our high growth markets always because it has some of the largest market, right? Whether apart from Japan, Korea, traditional market, China, India will be large markets in future years to go. So we believe Asia will continue with the growth at a high rate in foreseeable futures. Europe will continue its growth in spite of multiple challenges the economy is facing. US, we believe we have put in a lot of effort recently. The point is US has very less OEMs as compared to the Europe or Asia. However, we have broadened the base of the clients. Also the adjacencies which we talk about, which are more in terms of off-highway and trucks. With all this, we should be in a position to bring back the growth in the US. So there is nothing we are concerned about. The pipeline is good. Our discussions are good. It may take us some time because probably a little bit of under preparation at our side.
So do you expect the kind of mix around 28% from the US and 20% from the Asia? But Asia, as you said, is the strongest market. Do you expect the revenue mix to come more from Asia and less from the US going forward?
So, I mean, the way the industry is, right, Asia followed by Europe and followed by US, that's in the long term, that will happen. I don't know when it will happen. I don't want to predict that. But I think that the fact is that's how the overall auto industry is and tech spends.
Right. Very, very true. Okay, moving on to the big question, which really intrigued me. The big IT companies are acquiring the ER&D companies. You know, HCLT acquired ASAP, Infosys acquired ESAP, and latest, just most recently, Cognizant acquired Belkin. So how do you look at this kind of competition wherein the big IT services are expanding their footprints into the ER&D companies and setting to acquire their competition?
We had to focus on what we do. Okay, so we are the only focus company which is focuses only on automotive mobility. The second part is arguably we are the largest in the world in this area. Our growth momentum is higher than anybody else globally. The investments which we are making are ahead of the curve. So we believe we are in a good position, to take a higher share of business, is what we feel. But naturally, we cannot take any competitive pressure lightly. We do see the more competition coming from China, by the way, because the way the technologies these companies have, some of the companies are sourcing from them. So I think it's a global competition. I'm not looking at India or this. I think specifically, as you know, engineering services, anyway, earlier Europe has a very large dominant service providers. Indian companies are trying to catch up. We have established ourselves very well in Europe. We are established naturally here. So now we feel confident that globally we can be in a good position to capture the opportunities, bigger share of opportunity.
welcome you watching NDTV Profit. Well, V-Guard came out with its Q1 FY25 results yesterday, and it has been an impressive quarter for the company. Summer has acted as a catalyst for the electronic sales. However, electrical sales have seen a bit of pressure. But to talk more about how the quarter has gone by and how FY25 looks for the company, we're joined by Mr. V. Ramchandran, Chief Operating Officer of V-Guard Industries, who joins us now. Welcome to NDTV Profit, sir. My first question to you is that, this Q1 FY25 has been an impressive quarter and margins have expanded quite a bit. So do you think that this margin expansion will continue in FY25, or where do you see the margins going by the end of FY25?
So I think our margins will broadly come back to long-term margins. I think that's something that we've been working on since last year. The current quarter margins have been favorable because the mix is favorable. Electronics category sales have been good, fundamentally stabilizer and inverter battery. So I think that's helped to improve the overall margin. There have been some further input cost increases which have happened fundamentally. There's an increase in copper, aluminum, lead, and some of the oil derivatives. And